Michael Saylor just executed the most audacious trade in the history of corporate finance. He pulled off a maneuver that left the entire banking establishment stunned. He didn't just win a bet. He fundamentally humiliated the traditional gatekeepers of wealth by generating a $54 billion fortune right under their noses. We are not talking about a modest gain or a lucky quarter. We are staring at $54 billion worth of Bitcoin sitting in the corporate vaults of a company that was once just a boring software firm. MicroStrategy now controls a staggering 649,870 Bitcoin, making it the apex predator of corporate crypto holders on Earth, a position so dominant that it has distorted the gravity of the entire market. Consider the absurdity of this reality for a moment. A legacy software firm, unknown to the average American 3 years ago, now hoards more hard money than sovereign nations. This isn't a Cinderella story about a tech visionary. This is where the narrative shifts into something much darker and far more dangerous for retail investors. Saylor didn't just buy an asset. He weaponized a public company, turning a mundane enterprise into what Wall Street insiders terrifiedly whisper is a market cheat code that breaks their models. He built a loophole that gave institutional capital a way to bypass their own risk departments, allowing investors who were banned from touching crypto to flood into MSTR stock. But the NASDAQ 100 Index Committee does not view Michael Saylor as a hero. They view him as a systemic threat that must be neutralized. They are not preparing a trophy for his performance. They are preparing an execution that will serve as a warning to anyone else who dares to challenge the status quo. According to their arcane rulebook, MicroStrategy has committed a cardinal sin by betting the farm on Bitcoin, and the punishment is deletion. When the financial elite decide you have broken the unwritten rules, they don't ask you to leave. They activate a kill switch that ripples through the entire system. There is a date marked on the calendar of every predatory bank in New York, January 15, 2026, and it represents a potential extinction event for Saylor's empire. We are staring down the barrel of a financial catastrophe that could evaporate billions of dollars in seconds, triggered by a mechanism most investors don't even know exists. This is the story of the death spiral. And if you hold Bitcoin or tech stocks, you are standing in the blast zone. To understand the magnitude of the trap that has been set, we first need to analyze the glitch Michael Saylor exploited to build his mountain of gold. He realized before anyone else that institutional investors were desperate for cryptocurrency exposure, but were handcuffed by their own compliance departments and regulatory fears. By converting MicroStrategy into a Bitcoin proxy, he created a synthetic vehicle that allowed pension funds, hedge funds, and conservative money managers to ride the crypto wave under the guise of buying a boring software stock. The results were catastrophic for his competition, as MicroStrategy's stock performance absolutely demolished everything from the S&P 500 to the high-flying AI darlings like NVIDIA. Institutional capital poured into MSTR not because they loved the software business, but because it was the only lifeboat available in a sea of fiat currency devaluation. Saylor had effectively hacked the financial matrix, creating an infinite money glitch where buying Bitcoin raised his stock price, which allowed him to borrow more money to buy more Bitcoin. In a truly free market, this level of foresight and execution would be rewarded with monuments, as he delivered generational wealth to those who trusted his vision. But we do not live in a free market. We live in a managed system that prizes control above all else, and Saylor's volatility is an affront to that control. The NASDAQ 100 Committee sees a company that has violated the sacred laws of diversification, holding over 50% of its assets in a single, volatile instrument that they do not fully control. The irony is sickening. Saylor outperforms every major company in America, proving his thesis correct, and his reward is to be labeled toxic by the very people he outperformed. The committee is preparing to kick him out of the club, labeling his company a mono-risk violation that threatens the stability of their carefully constructed index. This isn't just a regulatory slap on the wrist. It is a surgical removal designed to cut off his access to the passive capital that has fueled his rise. Financial institutions of this caliber do not just politely ask you to alter your balance sheet. They weaponize their bureaucracy to force compliance or induce collapse. By deleting MicroStrategy from the index, they are not just removing a ticker symbol. They are severing the artery of liquidity that keeps the heart of this trade beating. This is about revealing how modern markets actually work. When someone wins too big using a strategy the establishment didn't authorize, the rules are suddenly changed to ensure they lose. Most retail investors operate under the delusion that stock prices are determined by the collective sentiment of human beings buying and selling based on value. That is a lie. In modern markets, the vast majority of volume is driven by mindless algorithms and passive index flows that do not care about fundamentals. When a stock is purged from a major index like the NASDAQ 100, it triggers a forced selling event that is automatic, non-negotiable, and executed with machine-like ruthlessness. We need to dissect the mechanics of this nightmare scenario because the precision of this trap is what makes it so terrifying. Trillions of dollars are locked inside passive investment vehicles and ETFs, with the QQQ Trust alone managing over $200 billion in assets that strictly mirror the NASDAQ 100. These funds are not run by portfolio managers who can look at the situation and decide to hold on to MicroStrategy because they believe in Bitcoin's long-term future. They are run by simple, ruthless code that has one primary instruction: own exactly what is on the list, nothing more and nothing less. The moment MicroStrategy is officially erased from the NASDAQ 100 list on January 15th, that code executes a market sell order. We are not talking about a fund manager carefully exiting a position over weeks to preserve value. We are talking about institutional algorithms dumping tens of millions of shares simultaneously. When a human sells, they worry about the price. When a robot executes a rebalancing order, it sells without any regard for liquidity, slippage, or the crash it causes. It simply dumps the inventory until the position is zero, whether the stock is trading at $1,000 or $1. JP Morgan analysts have already flagged this event in their private research notes, referring to it as a liquidity trap, which is a polite euphemism for a bloodbath. If you hold MSTR, or if you hold Bitcoin, you need to understand that the primary buyers of the stock right now are these passive funds that are legally mandated to buy it. The moment the deletion is confirmed, the buyer of last resort vanishes from the market instantly, leaving a massive vacuum of demand. Imagine trying to sell your home in a neighborhood where buying has just been outlawed. You don't lower the price. You realize there is no price because the bid side of the order book has evaporated. The market doesn't just go down in that scenario. It disconnects from reality, creating a freefall where shares trade at deep discounts to their book value because no one is willing to catch the falling knife. This forced selling creates a negative feedback loop. As the price crashes, human investors panic and sell, which drives the price lower, which triggers margin calls, which forces more selling. But for Michael Saylor, a crashing stock price isn't just a bad day on the market. It is the trigger for a potential bankruptcy event due to the leverage he employs. Michael Saylor did not build this $54 billion Bitcoin position by simply using the cash profits from his software business. He used aggressive financial engineering to leverage his company to the hilt. He issued billions of dollars in convertible notes, which are essentially loans from institutional sharks who gave him cash in exchange for the option to convert that debt into stock later. This strategy is brilliant when the stock price is climbing, as it allows him to borrow money at virtually zero interest while the lenders profit from the stock appreciation. However, this entire structure rests on a razor-thin assumption that there will always be liquidity and value in the MicroStrategy stock to support the debt. The moment that assumption breaks, the entire financial edifice starts to unravel with terrifying speed and violence. Buried in the fine print of these convertible note agreements are protective covenants and clauses that allow lenders to demand immediate repayment if the stock price or corporate solvency hits certain lows. If the forced selling from the index deletion crashes the stock price below specific tiers, the trap snaps shut and the lenders will come for their money. Here is the nightmare scenario that keeps financial analysts awake at night. If multiple institutional lenders demand repayment on the same day, MicroStrategy does not have the cash to pay them. The company's primary asset is Bitcoin, and contrary to popular belief, you cannot simply dump $50 billion of Bitcoin onto the market to pay a bill without incinerating the market. This is the definition of a death spiral, a feedback loop of destruction where each forced action makes the situation worse. If Saylor is forced to sell Bitcoin to pay debt, the Bitcoin price crashes. If Bitcoin crashes, his stock falls further. If the stock falls further, more lenders demand repayment. Unlike the traditional banking sector, there is no Federal Reserve to step in with a bailout package for a crypto company, and there are no circuit breakers for this specific type of debt-driven liquidation. The index rules are absolute. The robots will sell, and the consequences will be damned, regardless of how visionary Saylor's original bet was. The timing of January 15th, 2026, is particularly cruel because it acts as a hard deadline that the entire market can see approaching. Predatory hedge funds and short sellers know this date is coming, and they will likely position themselves to profit from the collapse, exacerbating the downward pressure on the stock before the deletion even happens. Saylor knows this is coming, and the banks know this is coming, but he is currently trapped in the prison of his own success. He cannot sell the Bitcoin now to diversify because that would signal a lack of conviction, crash the price, and defeat his entire investment thesis. He cannot buy another company large enough to dilute the Bitcoin ratio because nobody has that kind of capital lying around to make an acquisition of that scale. The trap is set, the door is locked, and on January 15th, someone is going to pull the trigger on the largest forced liquidation in the history of digital assets. The only mystery remaining is whether Saylor has a miracle up his sleeve, or if the system is finally collecting its due from the man who thought he could outsmart the room. Let's explore what happens if this spiral actually begins to spin, because the damage will not be contained to one stock ticker or one billionaire's net worth. This is a contagion event that creates a blast radius hitting every single wallet holding Bitcoin on the planet, from the smallest retail shrimp to the largest whales. Visualize the sequence. January 15th hits, the NASDAQ deletes the ticker, and the passive fund computers begin the purge of hundreds of millions of shares. The stock, which was trading at a massive premium to its Bitcoin holdings, suddenly becomes toxic waste that institutional investors are desperate to unload at any price. As the share price freefalls, the sharks holding the convertible debt smell blood in the water and demand their capital back immediately. MicroStrategy's finance department faces an impossible wall. They cannot refinance because nobody lends to a falling knife, and they cannot issue new shares because the market is flooded. That leaves the nuclear option, the option that every Bitcoin maximalist prays never happens. Saylor is forced to open the vaults and sell the corn. You might think, so what? He sells some Bitcoin, pays the debt, and life goes on. But you are drastically underestimating the scale of his position. We are talking about 649,870 Bitcoin, a hoard so massive that global liquidity simply does not exist to absorb it without a catastrophic repricing event. When you sell on Coinbase, you are trading crumbs that the market absorbs instantly. When you try to move billions, you aren't participating in the market, you are the market. The moment the rumor spreads that Saylor is forced to sell, the front-running begins, and every predatory trader in New York, London, and Singapore will short Bitcoin with maximum leverage. Market makers will pull their bids because they don't want to catch a falling knife, and the order book will become a ghost town. The mere announcement of a liquidation creates a self-fulfilling prophecy of doom where the price collapses before a single Satoshi is even sold. And the devastating truth is this. He doesn't need to sell it all to crash the world. Dumping just 10% or 20% of that stack in a compressed time frame would overwhelm the global spot market. We would see a flash crash of biblical proportions where Bitcoin could lose half its value in a single afternoon as automated stop losses trigger a cascade of margin calls. Now, multiply that pain across every retirement account in America that has exposure to crypto ETFs or direct holdings. Maybe you bought Bitcoin hoping it would fund your golden years, or maybe you are a true believer who stacked sats for a decade believing in the technology. It doesn't matter what your conviction is. When the Leviathan falls, everybody drowns in the wake. The crash does not discriminate between the faithful and the speculators. Everyone watches their net worth evaporate because one company got deleted from a spreadsheet. This is the systemic risk that the maximalists ignored. By cheering for Saylor to corner the market, they allowed a single point of failure to develop. And now, that point of failure is being targeted by the very system that Bitcoin was designed to escape. But we need to zoom out and look at the man behind the curtain to understand why this is happening now. How is it possible that a bureaucratic rule change can destroy billions in wealth without any regulatory intervention to stop it? This is not free market dynamics at work. This is a rigged game where committee decisions act as economic weapons. There is a theory circulating among the most cynical and seasoned financial analysts, a theory that sounds like paranoia until you look at the timeline and the incentives. They call it the Bank Heist Theory, and it suggests that this entire sequence of events is not an accident, but a controlled demolition. Think about the motivation. The traditional banking cartel has watched crypto with terror for a decade, viewing it as an existential threat to their monopoly on money. If Bitcoin wins, the banks lose their ability to extract wealth from the populace through inflation, fees, and fractional reserve lending. But they couldn't just ban it without causing a revolution, so they needed a smarter way to seize the asset class for themselves. They needed a kill zone, and Michael Saylor provided them with the perfect vessel to accumulate the supply into one vulnerable target. By allowing him to corner the market using leverage, they let him build a treasure chest for them, watching him accumulate coins at high prices fueled by debt. They let him march into the trap, and now, with a simple, bureaucratic flicker of the pen, they can trigger the collapse. They can force the price down to levels we haven't seen in years, creating a distressed asset sale of epic proportions. And who will be waiting at the bottom with billions in cash to scoop up the wreckage? The same banks that publicly mocked Bitcoin while quietly building their own trading desks and custody solutions. Imagine the wealth transfer. Saylor did the hard work, fought the volatility, and took the risk, only for the banks to step in and buy his bags for pennies on the dollar. They don't just win. They win using Saylor's own strategy against him, seizing the keys to the future of money from the hands of the believers. The deletion from the NASDAQ 100 is not a penalty for poor performance. It is a harvest, a coordinated extraction of value. And the brilliance of the plan is that no laws are broken, no backroom cigar-filled rooms are needed, just a committee following the rules to trigger a machine that eats everything. Michael Saylor bet his life that Bitcoin was the escape hatch from a corrupt system, staking his reputation and his company on that belief. He assumed that if he just held enough of the asset, he would become untouchable, a sovereign entity within the market. But he forgot that the system controls the exits, and when you play in their casino, the house always retains the ability to change the rules of the game. Now, the legacy financial system is using his own success as the weapon to destroy him, turning his greatest triumph into the mechanism of his potential downfall. The question you must answer for yourself is simple. Are you ready for the impact when the dam breaks? Are you prepared for the moment the biggest buyer in history becomes the biggest seller in history? January 15th is approaching, and the countdown is silent, but it is ticking louder every single day. When the bell rings, we will find out if Michael Saylor is the genius who broke the bank or the designated victim in the greatest financial heist of our lifetime. The exit doors are closing, and the time to decide where you stand is now.